And good afternoon, everyone, and welcome to a new and improved time and edition of Navigate B2B. I'm your host, Steve Ferrari, and I'm CEO of Ocean Audit, a global ocean freight refund consultancy company. I'm not going to say Hartford, Connecticut anymore. I'm going to kind of keep you guys guessing. I'll talk about that in a second. We've got big relocation plans in store here for the Ocean Audit family. However, welcome again to our new time slot. This is a great day for me on 2 o'clock. I love the fact that I can digest a lot of the comings and goings in the ocean freight environment and give you the latest before you break for the weekend. So for me, it's totally win-win. And how about all that great new programming on FreightWaves, some great hosts and some great content being published out there. And soon, of course, we'll be traveling again. I'm actually on a plane every 2 weeks now, feeling totally comfortable with it, vaccinated, ready to go, healthy. And I feel that we're just ready to turn that key for reopening. But boy, I tell you, it keeps getting to be a harder and harder move for everyone to turn it. I think it's almost like those, the limo door on like President Biden's, they call it the Beast, right? His limo, right? Have you ever seen that door? It is so bulletproof and so hard to open. I sometimes feel that the container shipping industry, ocean freight, is sort of like that door. We get a little crack open and then it closes again a little bit. And so we'll talk a little bit about some of the comings and goings in the ocean freight world today that are on my radar. Certainly, today's show is pretty darn unique. Spent a lot of time thinking about ways to bring more innovation to the program in these last few weeks in terms of the hiatus that I've had as we search for our new Ocean Audit corporate headquarter location and media studio has given me a great time to reflect. So nothing but blue skies ahead. And so right now the choices are really between Los Angeles, Miami, and New York City area. We kind of hit home runs in all three of those areas. And I might feel comfortable announcing it at the end of the show where we're kind of leaning towards. But anyway, keep it open for now. So again, welcome to Navigate B2B. I'm your host, Steve Ferrari. And as I said, my day job and my livelihood is based around Ocean Audit Incorporated, getting ocean freight refund recoveries for the Fortune 500 and beyond. And certainly this is a time where not only are refunds proliferating due to the ocean invoices being issued like a deck of cards, but it's also causing, as you can probably imagine, just complete chaos in the overall supply chain. Saw a great interview with Greg Miller on FreightWaves with Norwegius from Flexport, talking about the incredible quotes of $15,000 to $19,000 a container. So, we'll talk a little bit about that too, as it relates to what about the low value commodity out there? That's only $20,000 factory cost in a container, and the factory cost is $20,000 for the merchandise, and the ocean is $20,000. What do we do then? What happens to that? I've worked up a whole exclusive dossier for you guys on that topic, because I know a lot of my followers and viewers do have commodities that are not the $2 million high-end or exclusive apparel merchandise, but rather the lower end $20,000 to $30,000 FOB value type commodity. But first, a story that we takes a village, right? And certainly I'm not the Oracle of Ocean, right? Hey, that's a pretty good name. Oracle of Ocean. I think that will replace OK Boomer. Talked to a good friend of mine, if I had a brother, this guy would be my brother, John Monroe. John is a dear friend of mine. Love the guy to death. John and I have known each other for 30 plus years. And John does a heck of a job in his NVOCC consulting at Worldwide Logistics in his own practice. also the talented writer at FreightWaves, Greg Miller. Both of them gave me great ideas and concepts to launch this next story. And I would like to kind of talk about the how the ocean vendors have created this inefficiency, and I like to look at it as our own little bullwhip effect. And it really has to do with the fact that, within the port of Long Beach, LA, for months now, we've been reporting 20, 30 vessels outside the port. You've all seen the pictures from Newport Beach of the ships at berth in LA. And it's been what the media has reported on. The other side of the story, I forget, there was a famous journalist that said that. This is the other side of the story, is Oakland. So right now, Long Beach has done a pretty good job working the crews, ordering the right labor, getting the timing of the ships, getting things a little bit more stabilized. Now, there's about 15 container ships outside of LA, but the big story today that I want to report to is that there's about 15 container ships outside of Oakland. Now, the problem is, this is a doing of the carriers themselves, right? They sent these ships to try to alleviate the congestion in Long Beach, Los Angeles. And in so doing, kind of created this inefficient movement because, if you look at the chart here, you can see that there's only 8 berths available in Oakland and 40 berths available for container ships in LA. And so the big issue right now is the fact that besides a limited amount of berthing, still have labor and kind of port productivity issues. We used to call them PICs, right? Movements, production per hour, from how much the crane can offload and how much the infrastructure at the port can cycle a number of containers per hour. And so I'm not suggesting that Oakland is less efficient than LA in a good day to day. I'm just suggesting that the bullwhip effect is exacerbated by the fact that Oakland is still dealing with or trying to increase the productivity with labor and with timing, and it is causing that lag. So I think this is a very interesting slide graphic for the global trade in general, but more importantly, the import community that follows my show, so that we can help them. They may not be getting the full story, right? What's causing this particular lag? So Oakland is a heck of a story. And, in talking to John Monroe, I think that the consensus is in 4 to 6 weeks, we might clear that. But then again, what's that next crevice or crack that's going to cause, some additional strain? Some people say it may be a new variant of COVID in places like Vietnam or, will India reopen? So we have to really keep our eye on that. So that's really what I wanted to say about the opportunity or the informational situation at Oakland. I think it's something that we really should keep our eyes on right now. I think that the other thing that's really important to me is started looking at inflation, right? And obviously, you look at the Colonial gas pipeline situation in the East Coast here. They ended up paying the Bitcoin ransomware, to get that pipeline back and running. Inflation is obviously pretty high. I did a study, and this is another exclusive first on Navigate B2B from Ocean Audit and myself. So I'm a real big student of looking at the overall vessel manifests, and this is talking about low value type commodities. So if you look at the entire vessel manifest set coming out of Asia right now, most likely 10% of manifest data that I can get my eyes on in my arms around, 10% of the data. So not a huge subsegment, but a good enough snapshot when you look at the entirety of lift containers out of Asia. 10% have the value associated with the container, right? And so here's the shocking thing, and one of the key points I want to make on today's Navigate B2B show. Out of the 10% study that I did, 30% of the individual containers within this 10% segment, 30% had a valuation out of Asia. This is, the factory cost, how much the importer paid for the goods, of between $20,000 and $40,000 per container, right? And so I remember back in 1986 or 87, I was actually sitting in Oakland, California. I actually worked on the port when I was with Sealand, and we did a little group exercise, I guess you'll call it, where there was some thought back then that ocean freight rates should be, X% of the value of the goods. And so we were looking at some goods like, for example, I think a $500,000 container of what we'll call it refrigerators. And so I think back then the idea was, well, it should be 10%, right? So that would be a $50,000 ocean freight rate, which is astronomical and really kind of comical. But the point is that, 20 years ago, 30 years ago, the carriers were still thinking in terms of, the value of the cargo compared to the ocean freight rates. Now, there's a hypothesis. Could that be another thing, another reason feeding in to how the carriers are managing the current rate crisis? Because when you start looking at a container load of, let's call it widgets, or actually, you know what, let's call it, one of my favorite items that I see from Asia all the time is poly bags that you put your fruit in at Kroger's or in the fruit stand or at produce department, right? You store your apples and your pears in. So those goods might come in from Asia, and a container might be valued at $25,000, $30,000 maximum. And then you do the math on the number of those poly bags that are in each container. And I did a study on it. It was about, let's say it's 1 million bags, right? So you take the ocean freight cost of, let's say, $10,000, and then you divide it by the number of bags. The point I'm trying to make here is that, the landed cost of those bags, say a year ago or 2 years ago, might have been 2 cents, and then the ocean component might have been like 0.0003. So, barely any part of the actual bag itself. Now, today, that bag might be 2.25 cents or 2.5 cents, where the quarter of a cent or the half a cent is actually the ocean and the other landed cost, supply chain costs that have caused the importer to have a larger variable in terms of his profit margin being enhanced. He's got to do something with that. He's either got to increase the price to the distributor, the wholesaler, then pass it down to the customer. And, in speaking, I had a great LinkedIn conversation about this. I'll give a shout out to John Reeser, the VP at the Canon Group. And, John had a great comment about this very scenario that I'm describing. I'll read it to you. I thought it was so profound, I wrote it down. Steve, price increases followed by another price increase, followed by another price increase, and then another. Everyone is numb to this. And from the manufacturer to the importer to the distributor to the customer. And I just thought to myself, what he didn't say was, there's your inflation, right? So we see the inflation indices, really rising rapidly in our country. And I think the most important point of what Mr. Reeser said is that everyone is numb to these increases. We're accepting it. And that's causing the price to pass on, of course, to the consumer. And that's causing inflation. Now, I really want to talk about these lower valued items that I saw the other night. I mean, a lot of them were like foodstuffs. For example, frozen onions, frozen peas. Now, you could say that these items were already in the supply chain and they'll be ferreted out, so to speak. However, I do believe that this is another chance for American B2B growth, where the lower valued items could hypothetically maybe be produced or worked domestically or sourced domestically for roughly the same price that you would, say, get a product on an imported basis. So it is really something to take a look at, these lower valued items, because they do make up extraordinary amounts of the overall container booking, right, environment. Now, how much more can we support? We're already into, as I said, the 10, 15, 19K rates in some of these instances. So it's a pretty phenomenal issue. And I think that we have to really, I think that the ocean carriers won't do much about it. But I think that the importers, that they will be the ones that will have to control, how they source. And, as I said, many of these items are foodstuffs. So, I mean, do you go to Mexico? Do you find other suppliers? Do you, because I don't know about you guys, but I know everywhere I'm going, I see these huge signs now. I'm sorry, sir, the supply chain is going nuts and your product may be out of stock. We may be seeing more of that. I have advocated for the last several months, when no one else would speak about it, that ocean container growth on major commodities, apparel, furniture, reopening type commodities, will increase by over 100,000 units a month. I may have been too low in my prediction. We will see a shift of more higher valued commodities. We will have to. The lower valued commodities will either not make the vessel, or they will be priced out of the market from people being too numb to the various price increases the lower items have to take. Now, could they potentially be absorbed? And it's a bit of a game of roulette, though, I think, if the importer continues to try to absorb those. So I think that that's something that we really have to keep an eye out as we provide the analysis to the trade. And I'll keep a steady eye on that. What I'd like to talk about now, and by the way, you're watching Navigate B2B. I'm Steve Ferrara. For those that are new to my show, this is our new time slot at 2:00. Yes, we are live, and it is so great to be here. Now, I think I have hit one out of the park, literally. I mean, in container shipping, there are not a lot of new innovations. There's container ships, there's cranes, there's double stack trains, there's APIs. I mean, you could kind of probably list, 8 or 9 or 10 things that have been really important in containerization and ocean freight over the years. Now, what I'm about to say is very innovative. Certainly, it's not going to impact the way that any of my clients ship, or it's not going to impact anything that moves cargo in the supply chain or the velocity. But it is going to be data oriented. It is a very unique approach from a data orientation perspective that I want to share. And this is a FreightWaves exclusive. This is Ocean Audit exclusive. And I want to talk about the use of ocean freight data and earnings correlation, how earnings and ocean freight FEUs correlate to predictive revenue for publicly traded companies. And so I put together this graphic, which I think is extraordinary. I just picked two mainstream publicly traded companies, L Brands and Target stores. And one of the things that I do in my back office algorithms type material is I look at the commodities, and as I said, some are able to assign a value, but others I assign my own values. And when I assign a value, in the case of those low valued items I was speaking of earlier in the show, those are FOB factory costs, right? They're not what you retail those items for. I created an algorithm that pretty much spot on with, plus or minus a 10% deviation, gives a retail value of the goods inside a 40-foot container, right? And so you can look at these earnings, quarterly earnings on obviously every 4 months. And obviously there's a little bit of a backlog from when a good ships to when it arrives on a shelf. And so there are some factors that I can't correlate to. And this system really works for very heavily dominated importers that rely very heavily on ocean freight or retail imports for their success. And, there's hundreds of them, right? So what I wanted to show on this chart, what's important on here, is the FEUs. This is Q1 2021 data. So L Brands, has 1,500 containers in Q1 2021. Target stores had 46,000. Now, I assigned a retail value of each limited goods brand cargo at $2 million, and Target's mixed commodities of furniture and low end kitchenware and mid range apparel, $500,000. And these are fairly conservative numbers. They don't even really touch the upper end of the range of my algorithm, right? So they're tried and true numbers that really fit. They fit very well, very well. Again, they fit well when you're not an analyst and you're not, a Target store, sitting at the CFO board level. So I'm looking at this and I say, okay, the Q1 numbers that Limited and Target declared for revenue, $3 billion for L Brands, about $3.01 billion, and $24 billion for Target. It was almost spot on. The model works by taking the ocean freight velocity on a given quarter. You can kind of understand how this would be important to analysts and hedge funds and Wall Street and just banks in general. This is a great predictor, right? And in terms of how the economy's doing, how the stock's doing, how that individual company's doing, the velocity of that company, and also, I think it bears mentioning that with a greater velocity, right, then obviously that company is able to say, hey, wow, we're really up this quarter. We're able to use that number somewhat holistically and perhaps negotiating, better packages of ocean rates going forward, depending on the partnership with the ocean vendor. But the point is that for the first time that I believe, I've developed a way that helps the market understand the revenue side of where a company might come in. Now, of course, there's earnings per share, there's revenue, there's expenses. Some of that's beyond my control. But the revenue side is a very, 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 very interesting dynamic that we can now model that very efficiently, almost to the point where we're, we could almost say, how you have in the stock market, right? You have analysts will come in a high opinion, a low opinion, and they take an average, right? So, I feel that my number would be an analyst where it comes in at a very targeted number. I won't be the high, I won't be the low. I'm going to be, kind of like a professional analyst in some ways in terms of understanding that number. And I just think it's an important, I'll never leave my the calling that I have to support all my import clients and export clients getting refunds. But it is important to help understand the dynamics and the velocity of how much these containers are impacting landed cost revenue. And so I think it's a really great topic that we should continue to develop and continue to perfect, not only through the FreightWaves media and great reporters that we have that look at this, but also through my own ocean audit work, where I support many of my retailers by helping them see and peek into what the data, or as my good friend Lori at CNBC says, what the tea leaves say, that containers don't lie, right? So I think it really comes down to that. So, really, really terrific, big news on that. And I've long held that ocean freight was a predictive tool that Wall Street used. I now see how it can be used in much more deeper and analytical ways, and now more than ever. Okay, so let's move off that topic, and I wanted to talk a little bit about the incredible quarter that Zim Lines had. Zim is a really intriguing company to me. I think as part of this discussion, I want to bring up a good friend of mine, Jay Mintzmeyer, who Jay is the head of investor research at ValueEdge Investors. And Jay is a Air Force Academy grad, getting his PhD at Harvard. And ValueEdge provides really cutting edge look into the equities market in terms of shipping. And so Jay has done a lot of this work in terms of breaking out the thoughts on various equities. And certainly I'm telling you this for entertainment value or informative value. Anything I say is not investment advice. I'm not an investment professional. Jay does not give investment advice either. So these are just thoughts that, come into play, like any two guys talking about, the strength of a particular movement of a stock or why it happened. So I love what Zim did. Zim had an IPO months ago at 11. They're now at $45 a share. They had a blowout quarter, and they had a great forward guidance, they call it, on what the next year or so will look like. So terrific year for them. And Jay had made mention of this in kind of his private client chat, which I'm part of. That Zim is good, right? And Zim is everyone's darling right now. But Zim is sort of like a Mustang or like a hot Tesla. But there's another stock that's like a Ferrari, like a Lamborghini, right? And this one you don't know anything about. And the name of that company is Danaos, and the stock symbol is DAC. And believe it or not, Danaos has a portfolio with charter ships, but they also did a deal years ago with Zim before Zim went public, where Danaos got 10 million shares of Zim stock as part of a deal with Zim. And so that now that stock went from being worth nothing, right, to over 500 million. So Danaos trades at about $60, $62 a share, and about $10 or $12 of that, I believe, is Zim portion, the Zim stock, right? So Danaos actually has a projected net asset value, the sum of all the parts of what they've done, of about $90. It's not a stock prediction, but it's the actual value of Danaos's assets, about 90. Now, the difference between Zim and Danaos, right? Obviously, Zim is a light asset ocean carrier that relies on rates, both short-term and long-term. But let's call it like it is, right? We don't know what the rates will be 6 months from now, but Zim relies on those rates, and they have contracts. And Danaos, on the other hand, what makes them the Ferrari is they're locking in 3.5 year ship charter rates at record levels, world record highs. And so that's the reason why some investment pros, like Jay Mintzmeyer, believe that Danaos actually represents a better value in the market than Zim. Of course, do your own due diligence, and you could follow Jay on LinkedIn and talk to him for more information on his thoughts. But he's a guy I trust. I really admire him and follow him, and I think that's it's an interesting topic to look into. So I think that you've been watching Navigate B2B. I'm Steve Ferrari, your host. We will be releasing my second. Hopefully, some people think this book could land at #1 on the USA Today bestseller list. Navigating B2B will be released around the July 4th weekend. And we are working on another opportunity to create a type of, I'll use it this way, a type of cryptocurrency that will give ocean importers free ocean freight for a short duration of time. And it's at no cost to the ocean importer. And I'll tell my clients how to use that type of mechanism in some more dialogue. But for now, I just wanted to leave you with saying thank you for all the time today and listening to me and talking about navigating B2B and ocean freight, the ocean freight market. Wishing you all a great weekend. And until next week, we'll see you then. I'm Steve Ferreira signing off. Enjoy.